So we talked about the similarities between commercial and residential loans. Let's talk about the differences. Some of the main differences are in terms of rate and structure and term. And what does that mean? So rate. Residential rates are typically lower if you have good credit because the government's buying the mortgages on the market, or government-owned companies are Fannie Mae and Freddie Mac. That drives rates down to I would call it almost an unnaturally low rate. On the other hand, on a commercial loan, a bank is actually loaning the money. So the bank needs to loan money where they can make money, and that depends on how much their cost to operate and how much their deposits are. They're paying for deposits, and so you're going to have a higher rate. You're also going to have different structures on commercial loans. So with a commercial loan, if you're buying a piece of equipment, a bank is going to structure the loan along the expected lifespan of that piece of equipment. So if you're buying something that's going to last 7 years, they're going to match it to be 7 years or less. If you're buying a building, yeah, you could get a longer term, but it's not a 30-year term. Commercial mortgages are not even called mortgages, but commercial loans for buildings, they're going to go probably the most 20 years, sometimes 25, but you don't have 30-year loans on commercial buildings. That's not what the market has. You're used to, I get a 30-year mortgage at 3.75%, and I'm great. Why don't I get this for my commercial? Your commercial is probably more like, I got 5% fixed for 5 years, and then I have to redo my loan on my building. If you're just now getting into buying commercial property, it's one thing to be aware of. Lines of credit, another thing to address for businesses, that's very different. So a consumer line of credit's a credit card most of the time, or a home equity line attached to your house. With a business line of credit, it's usually backed by accounts receivable, it's backed by inventory. There's a percentage that a bank will loan that company on that based on how good your receivables are, how good your inventory is. And so it's a lot different from a structure standpoint.